Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron Ogti and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
In this episode, Trishul and Aaron discuss alternative forms of employee equity compensation. In addition to ISOs, there are NSOs, RSUs, and ESPPs, and each one comes with different tax implications. Your employer can grant you access to any combination of these plans. So then, how do you decide when to exercise and when to sell? You can choose to hold on to everything for the upside, or you can sell everything as soon as possible to lock in your benefits. But most people end up somewhere in the middle, and that's where things get complicated. And now, on to our conversation.
Hi, my name is Aaron Ogti. I'm a financial advisor in the Bay Area, and I'm here with Trishul Patel, a wealth manager on the East Coast.
Hey, Aaron, great to be here today, and thanks everybody for listening.
Great to be here as well. So the last few weeks we've been talking about incentive stock options and some of the strategies, especially with ISOs and private companies, where there may or may not be tax implications when you exercise, but you can't sell the shares to be able to provide either liquidity for exercising or liquidity for the usually AMT bill. And one of the things I mentioned towards the end of those series of conversations was it was looking at just ISOs, but in reality, as the company matures and they get closer to going public, other forms of equity compensation start to come into play. You can't have over $100,000 vesting of ISOs in any single year. So if the value of the company is going up enough and your grant's big enough, okay, so now you're going to get a split grant between ISOs and NSOs. So now you have both ISOs and NSOs. Also, as you get closer, the company might start offering restricted stock units, so doing grants of RSUs, where there's no longer the option, but you are still getting some stock, and don't get the same choices. Usually, these are taxed as they vest. I'll go into double trigger vesting in just a second. And then after the company goes public, a lot of companies will offer an employee stock purchase plan, an ESPP. So we're kind of go over today, when you have these four different types of equity compensation, what are some really quick primers on the taxes, and how do you decide which ones to sell if you are looking to sell some shares? And I'll kind of get into the conversation of the taxes, cashing out, diversification, etc. But Trishul, kind of really quick, do you have any quick questions on ISOs, NSOs, RSUs, or ESPP that you want me to make sure we addressed throughout our conversation today?
Well, I think things can get a little hairy once you have multiple stock plans to consider within a single client portfolio. So I'm really interested in understanding, how do you tee these off against each other in those types of situations? I'm definitely going to be taking notes there. But, I think just to get things going, maybe just a high level overview of each of these would be great.
Okay, so we're going to say kind of continue our conversation from the last few weeks. The company is now publicly traded. Okay, we are at least 6 months past the IPO, so that you can sell these shares. A few of the caveats that will come into play. One, if you're still an employee, a lot of companies will have trading windows. They'll have blackout periods of when you can't trade, up until a quarterly earnings call, maybe a day or two after, and then a trading window will open. Could be a couple weeks, could be a couple months, but each company is a little different depending on when their next quarterly earnings call is. So, but they'll tell you, okay, you can trade only within, say, a month after the earnings call, and then you can't trade 2 months prior to the following earnings call. So we can still sell all of our shares that are vested, but we have kind of be aware of the trading windows. That's one little caveat. With RSUs, restricted stock units, they're taxed at vesting. With private companies, this was an issue for a while where the RSUs would vest. You have a time service component. So again, using our example from last few conversations, it's a 4-year vesting, starts out first year. We'll just say it's 25% each anniversary. The IRS rules is that it's getting taxed at vest. So you actually might have the situation in the past where RSUs are vesting, you owe the taxes, but if it's a private company, you couldn't sell the shares to pay the taxes. Most companies now do what are called double trigger vesting, where it's both the time component, again, vesting over 4 years, plus some kind of liquidity component, usually a IPO, a liquidation or a purchase, merger acquisition, or even the post lockup. So there's a 6-month lockup. They might say they don't vest until you can actually sell shares. Not all companies work exactly like this, but so each IPO can be a little different. Sometimes they will vest on the IPO date. Sometimes they'll vest when you can actually sell the shares after the 6-month lockup. But the idea is that when they vest, you can sell the shares to pay the taxes. So a very common default procedure is you have a certain number of RSUs vest. On that vesting date, a percentage of the shares are sold immediately to cover the taxes. This feels a little bit like a cash bonus, where if you get paid a cash bonus, a certain amount of that is withheld for taxes. And you'll get, say, 55 to 65% of your gross cash bonus as your net, kind of after they cover the taxes. So RSUs tax as they vest. They usually sell the shares to cover those taxes. Depending on the stock plan, you could set it up where you want to hold on to the RSUs, but now you have to pay the taxes and you could do other withholdings. There's lots of extra risks there. So we're just going to go with the default process for today's conversation.
Well, just a quick question on that. What would be two questions, I guess. What would be the difference between an employer saying, hey, here's $10,000 as a cash bonus, or here's $10,000 as an RSU? I guess that's the first question. The second question is, now for the double trigger vesting, what kind of went through my mind there is, okay, that's great. Now you have the second trigger. So once your shares vest, even though it's not liquid, you don't have to pay taxes because you get to wait till the second trigger, which might be like 7 years after that. Great, you get to not pay taxes for another 7 years. That's when they'll officially vest. But, what if you don't want to stick around for 7 years? Does that mean you lose those RSUs because they haven't hit the second trigger? You're kind of stuck with that company until it goes public. So, yeah, any insight on these two questions, Aaron?
So the first one, my wife actually went through this. She had RSUs that were vesting, and her company was taken private. It was bought out by a private equity firm. So now they actually do cash incentive bonuses, where it's actually a cash bonus, but has a vesting schedule. Would have been the same amount as the RSU grants, but has the vesting schedule. And so she gets it announced it's going to vest over 4 years. She'll get 25% each year over the next 4 years. The RSUs work a lot like that, but you add in the volatility of the stock. So if the company can grow, what was a, say, $40,000 bonus vesting $10,000 per year over the next 4 years is now a $40,000 RSU grant with $10,000 of today's value of stock vesting every year over the next 4 years. And so if the company does well, while you're waiting for that to vest, it can grow. It can also go down, though. So, and the idea is that if it goes down, you pay less taxes. So it's not quite as penalizing. But it's just like all other forms of equity compensation. The theory is we're getting all of our employees invested in the growth of the company by tying part of their compensation to seeing the company grow. And so that's the idea with the RSUs. So it's taxed very similar to a cash bonus. You just add in the potential for upside, and because you have the potential for upside, you also have that potential for downside. it actually works very, very similarly. If you got a cash bonus, let's say the stock stayed flat, no volatility, stock stayed flat. If you got a cash bonus, they withheld the taxes, you took your net bonus, transferred it to a brokerage account, and bought your company stock. Because not only does the taxes at vesting kind of work the same, but that establishes your basis on that day. So if you were to sell all of your extra RSUs that you held on to, there's no capital gain because it's the same day as a vested. The vesting date determines your basis date. There hasn't been any growth on that exact same day. So you could sell all of your RSUs without any extra tax implications. If you hold on to your RSUs, then you have your basis value, basis date. So if you get normal capital gains or capital losses, if it goes up and you hold it for 12 months, then you get long-term capital gains. If it goes down, you get some capital loss. So you've paid ordinary income taxes on the entire amount. And then from that vesting date, if it goes up or down, it's capital gain or loss. And then how long from vesting date determines short-term or long-term. So functionally, it works very similar. If you got a cash bonus, taxes withheld, took that, bought your company stock, that's your new basis. If the company goes up, you owe capital gains. Company goes down, you get a capital loss. Does that make sense on the RSUs?
Yeah, that does help. So just in my mind, there's really no difference then between the two, just not to put too fine a point on it.
Correct. It's actually like just the classic choice architecture of opt-in versus opt-out. Your default is you already have the company stock. Do you choose to sell? Whereas default is just your status quo is you hold on to the stock. Versus if you get a cash bonus, your default is you have cash that you can invest any way you want. Do you choose to buy the company stock?
Right. Exactly.
And then your other question was
the double trigger.
Double trigger. I'm going to say this is plan specific, but most of the time you would lose the RSUs if you left before that liquidity event.
Yeah.
Because this is kind of the way the taxes work. The IRS says kind of for all forms of compensation kind of acknowledges when you get paid, you owe taxes. Now, they can add in a double trigger so you can still lose that money, therefore you do not have to pay taxes on it. So if you have removed that risk of forfeiture, then you have to pay the taxes on it. Right. So that's kind of why if it's a double trigger vesting, if you don't want to have to pay taxes, then you maintain that risk of forfeiture. Depending on the plan, there might be an allowance for 83B elections where you can kind of pay the taxes on the RSUs before they vest. The idea here is you want to pay it if you think the company's going to go, the stock's going to go up, you can pay the ordinary income taxes on the lower current value, and hopefully it grows, and then you establish your basis date a long time ago as lower value. So now instead of ordinary income, you have long-term capital gains on some of that growth of the stock. You still maintain the risk of forfeiture. So if you leave the company before the time vesting component is, you may not, you probably don't, you don't get the tax, you definitely don't get the taxes back, but you might not get the shares either. With options, again, company plan specific, some companies will allow you to keep the options through their 10-year expiration date. Some will say you have to exercise the options within 90 days if you leave the company. If you leave the company, you might be able to keep the option with the ISOs, definitely become NSOs. You have to be an employee to have ISOs. So again, it's company plan specific, but you at least have some choices there or some flexibility where you can exercise the options and now you own shares. That's one of the big things. Restricted stock units are actually called that because they're not shares of stock. There also are restricted stock, so you actually have the shares with a vesting schedule, and there's different rules around that. That's what kind of the way it used to be. Those kind of fell out of fashion. RSUs just work a little better for corporate accounting perspective. So RSUs are the most kind of dominant form of shares with a vesting schedule. But yes, if you have RSUs, you satisfy the time component, but the company has not gone public, not been a liquidity event, that can be another kind of golden handcuff situation where you haven't paid the taxes, but depending on the company plan, you may not get the RSUs if you leave the company.
Right. Yeah. Certainly a double-edged sword there to think about.
Yeah, it's great. I don't have to pay the taxes on something that's illiquid, but also that's because the IRS maintains that risk of forfeiture. You haven't been compensated, so you don't get to keep them if you leave the company. If you don't satisfy those vesting requirements, there might be other workarounds that are possible, but that's again company plan specific. The last thing we're talking about today is employee stock purchase plans, ESPP. The most common forms of these are you have your money coming out of your paycheck over a 6-month period, and then at the end of that 6 month, they'll look at either the stock price at the end or the beginning of that 6-month period, and you get to buy your company's stock at the lower of those two prices. Most plans also offer a 15% discount. So you actually get a 15% discount on that lower purchase price. So this kind of has a minimum guaranteed rate of return of 15%. It's actually like 17.6 when you give time value of money, and just the way that works out. But you have this minimum guaranteed rate of return of at least the discount, assuming the stock stays flat. Realistically, just because stocks do a great job of moving up and down, and you get to choose the lower of the two prices, you get a pretty hefty return. Now, there are limits on ESPPs. You can't put more than $25,000 into an ESPP plan per person per year. And that's based on the gross value before the discount. So if your company offers a 15% discount, the most you can do is actually $21,250. And I want to double check my math. 25,000 times 0.85 equals 21,250. So you can put in 21,250 and you get to buy the stock at the lower of two prices on a 6-month period. The discount is taxed as ordinary income, and I don't want to go too deep into kind of qualified disposition versus disqualified disposition. That's not the purpose of today's conversation. But roughly, if you have the stock, double check. I think it's 2 years from the date of participation. So it's usually the beginning of that first 6-month period, and you hold it 1 year from the purchase. So depending on which purchasing window you're in, then you can have it where the discount is still taxed as ordinary income, but the purchase price to the sales price could be capital gains. If you don't hold it that long, then the spread, so again, because you get to have a look back, so if the stock was at $10 at the beginning and it's now at $14 at the end of the 6-month period, you can buy it $8.50. You still owe taxes on that $1.50 discount, $10 minus 15%, but now your basis is $8.50, and the gain from that to 14 is capital gain, but your basis gets adjusted based on the discount. So it might be like a $10 capital gain if you hold it for those time periods. ESPP is sometimes almost just as, if not more complex as ISO planning in terms of, especially in terms of reporting. Sometimes making sure that 15% discount isn't always applied to the basis. So a lot of times when ESPP shares get sold, there has to be some kind of basis adjustment because you do owe taxes on that discount. And the IRS tries to do a good job of making sure you're not paying this double taxes on the same portion of your income. So if that discount's going to be taxed as ordinary income, you don't also have to pay capital gains on it. But if the stock goes down, that can also reduce what your taxes paid. So ESPPs, very complex. It's a conversation for a different day. But the idea is if you hold on to ESPP shares, you can get some preferential long-term capital gains treatment. But even if you sold right away, you have a guaranteed positive rate of return. So that's going to be kind of some of the themes of when I look at these 4 different types of equity compensation: ISOs, NSOs, ESPP, and RSUs. One, there's no rule that you have to sell. Okay, you can hold on to shares. That is an outsized risk, but you're taking on a big risk for a big reward. You can hold on to shares, and kind of the longer you hold on to shares, the more long-term capital gains you get. Maybe you're trying to get that life-changing wealth, but also a single company stock can cut down in half and then never recover. So that's a realistic possibility. If you want to take on that risk for that upside, you don't need to sell. You can also just cash out everything as soon as possible. That's the other end. Like you can remove as much of that investment risk as possible. The options, you wait until the company's public. As soon as it vests, you just sell everything. Both ISOs and NSOs will be treated the same way. RSUs, as soon as it's vests, you sell everything. You've already paid the taxes. You don't want any extra taxes. ESPP, you got your discount, 6-month period. You go in and sell the shares. You actually got a guaranteed rate of return, and the difference between your purchase price after the discount and your sales price is all taxed at ordinary income. So you're paying the highest tax rates, but you have the least investment risk. So, and then realistically, most people are somewhere in the middle. We're going to keep selling some, we're going to keep holding on to others. And if you're willing to take on some investment risk, and we're trying to sell in as tax efficient manner as possible, while we're still diversifying with some of it, how do we do that? How do we prioritize which forms of the equity compensation do we want to sell? Again, kind of balancing the investment risk, diversification, and tax efficiency. So
Right.
With those 4 things, Trishul, is there anything you either want to ask about or add in before we go down this path?
Well, I like what you said about the ESPP with the 15% discount. That sounds like, some free money's there if you have the option to jump in on that. There could be some risk that it does go down before you actually do sell. So it seems like that is part of the risk. But what I'm also hearing you say is you could get the discount, obtain the shares, and then immediately sell. Is that right?
Correct. It's if you sell right away, you will pay ordinary income taxes, but you have a guaranteed rate of return because you get the look back period plus the discount. Mm-hmm. If the stock stays flat and the stock is the same value at the end, like you can either go up then down or down then up, and it ends up being the same.
Right.
There's no time value benefit, but you still got the 15% discount. So you turned your 21,250 into you get back to 25,000. That's what it is. That's where that 17.6 rate of return comes in. You paid 21,250. You got 25,000.
Right. A 15% discount is a 17% gain.
Exactly. Yes. And let's go back to a 10% decrease requires a 11 point something percent rate of return to get back to even. Yeah. Same thing. 50% discount equals a 17.6 positive rate of return.
Yeah, so this does highlight a couple of things based upon what you've said so far. One is the notion that we started with, yeah, it is possible to have a bunch of these things in one client portfolio because, as you mentioned, there is a cap on the ISOs of 100,000 a year,
Yep.
and there's a cap on the ESPPs of 50,000 a year,
25.
sorry, 25,000 a year, and yeah, but if you're above that, then there has to be more buckets that hopefully a company can leverage, and that's why you could have multiples of these in a single client portfolio. So that certainly makes sense. And then at a high level, what I also hear you saying is, and then there's a few things you need to ensure so that you don't end up with disqualifying distributions if that's not what you're going for. Meaning, if you're going for favorable tax treatment, there's ways that you can maneuver each of these things, and they each have their slightly nuanced rules that go along with them so that you could get favorable tax treatment. However, with that favorable tax treatment, it sounds like there's a trade-off here where you're going to take on some potentially more investment risk. Your holding periods might be longer, but your upside might be a little higher and your tax burden may be a little lower.
Correct. So I usually use an example in a client conversation. There's a spectrum between investment risk and taxes where you can have the least investment risk and pay the most taxes, or the most investment risk and pay the least amount of taxes. And most clients end up somewhere in the middle. It's some combination of the two, especially when it comes to ISOs and you start to add in AMT. The other big thing that's a difference is the leverage that options provide. And we talked about this last time, but I need to kind of re-illustrate it. If you have an exercise price of $1 and your current stock is at $2, if the stock goes from 2 to 3, that's a 50% rate of return. But your value went from 1 to 2. There was a $1 spread, 2 minus 1 goes to a $2 spread, 3 minus 1. So a 50% rate of return on the stock meant that your option value had a 100% rate of return. It actually doubled in value, went from 1 to 2.
Right.
But if you saw that $1 strike price and stock was up to $10, now going from 10 to 11, actually, we can do the same going from 10 to 15, another 50% increase in the stock price. Your equity goes from 9 to 14. And let me get my calculator. That would be a 55% or 56% rate of return. So when there's a lot of leverage, strike price is close to current stock price, you can get an excess rate of return on that growth. When the stock is much higher than the strike price, so you don't have as much leverage, in our example, a 50% rate of return was only a 56% growth in the spread value of the option. So again, there's still some benefit, but it's not as outsized as it was. So with the options that you have, and you can actually just do this math for yourself, like if the strike price is $10 and the current stock price is $12, you have a lot of leverage there. But if the strike price is $10 and the current stock price is $60, you don't have the same amount of leverage. And that's going to be one of the things that comes into play when trying to decide, do we sell options or the ESPP? And I'll get to that a little bit later. But that's just, I think you have a good primer on basic understanding of taxes, or at least where you need to do some more research, and the leverage being the other factor. RSUs, there's no leverage. If the stock goes up 10%, your value goes up 10%. There's no leverage on the RSUs. So between no leverage on the upside or downside, and the RSUs are taxed as they vest at ordinary income, they're already taxed that way. Selling the RSUs as they vest tends to be kind of one of those default financial advisor recommendations that if we know we're selling some stock anyways, okay, we've already done that part of the planning, and we have all 4 of these, selling RSUs as soon as they vest usually helps provide liquidity. We don't get any leverage by holding on to it. There's no extra tax implications. We've already paid the taxes on the vesting anyways. So that tends to be the first thing that gets sold. That if we're going to hold on to anything, it'll be ESPP or options. So selling RSUs as soon as they vest among the four tends to be the first thing that gets sold.
Right. That makes sense to me because, as you said, it's similar to just the cash bonus. You could sell it, and frankly, you could buy that stock or any other stock you want, and then you'd pretty much be back to having a stock position if you really wanted to, but you would be in full control. It'd be in your brokerage account.
Correct. And most of the time when we're selling, it's either being used for lifestyle for some perspective. Maybe they want to be a down payment on a house. Maybe they want to use this to fund kids' college. Maybe they actually want to diversify so they can retire, or they just want it to take on less risk. They're still farther away, but they want to invest in an all equity portfolio that we've talked about before in the past. So it's large cap, small cap, international developed, and emerging markets. That would be a good long-term growth portfolio, but significantly less risk than a single company stock. So yes, right. Selling RSUs as soon as they vest and diversifying tends to be step one. With non-qualified stock options, the advice tends to be waiting until you're ready to sell before you exercise. Because with non-qualified stock options, it's taxed as ordinary income when you exercise, and therefore you're probably selling those shares to exercise. It usually doesn't work if you're trying to pay taxes with outside money. So waiting until you're ready to sell the non-qualified stock options and paying ordinary income taxes on that entire amount, you kind of get the leverage component, but there's no particular reason to hold on to it after the exercise. Once you exercise it, it kind of looks and feels a lot like the RSUs that are vested. You have your basis, and if you hold on to it 12 months after that, you get long-term capital gains, but you only get long-term capital gains on the growth from exercise to that period, where you've already lost the leverage. So by exercising, you've given up the leverage. You now have functionally the same as RSUs. So that's why when we give up the leverage, holding on to non-qualified stock options, trying to get hope for growth, and then getting long-term capital gains on that growth tends not to be worth it, because if the stock stays flat, there's no extra tax benefits. You took on the investment risk, you paid all the taxes, and you didn't gain anything. So, and you've taken on the risk that it goes down. So that's why non-qualified stock options, waiting until you're ready to sell to exercise them, but paying attention to the leverage side. So if there's a lot of leverage, it probably makes sense to hold on to them. If there's not much leverage, then it probably makes sense to sell. Does that make sense, Trishul?
Yeah, it does make sense. I guess the caveat there is you're talking about a public company where you can sell after you exercise.
Yes. That's kind of what we talked at the beginning. All the, because again, with the RSUs, you can't sell those if it's not public either. So
right, yeah. I guess the reason I bring that up is I actually had to go through the similar mental gymnastics when I had NSOs or NSOs in the past myself. And I ended up exercising after they vested, and it was for a private company. The concern here is when they, at that point, I was basically required to pay taxes on whatever their fair market value was at that time, counted as income. And the reason I wanted to exercise them is because I wanted long-term capital gains treatment, from that point until the point where I could hopefully eventually sell them. Again, not a public company, so that wasn't an option. But I wanted to start that long-term capital gains clock when the stock price was as low as possible. And, what kind of nudged me in that direction, was two things. One, my exercise price was pretty small, de minimis. These, as we had said, sometimes the the exercise price can be quite low. It was less than a penny for me. And the fair market value at the time of exercise was also low. So I was jumping on the notion that, okay, I am putting quite a bit at risk, but it's not so much at risk that I wouldn't mind losing at all. In the potential that it goes up from there, any other gains between then and the point where I could finally sell would be long term.
Do you happen to remember if that company was eligible for QSBS?
You see, I think a few missteps there. I think it would have been eligible for QSBS, and I think I could have done 83B election as well, and that's something that also left us a bit blindsided by the time we learned about all that.
Okay, so I think that when we have those really, really low stock prices, that tends to be one of those factors where, like you said, it's not so much the leverage that we're concerned about, it's just the de minimis component where, yeah, the exercise plus taxes just might be a couple grand, few grand. Right, and so it's an affordable risk, but at that stage, it's still very much, you most likely aren't seeing this money again.
Right, yeah, exactly. It's a lottery ticket at that point.
And so I think kind of going back to our conversation over the last few weeks, when I think of NSOs, I tend to think of the company being more mature. And from that perspective, I don't think it's a de minimis. I think it's okay, are you going to put 50 grand at risk or 100 grand to exercise these NSOs for a company that's not yet public? And you have to pay taxes on the ordinary income taxes on the spread. So will you put 50 grand just for the exercise cost plus, say, if the spread is another 100 grand, you're going to owe another 30 grand in taxes. So in this example, let's say your current exercise cost for everything is 50,000, but the stock is worth 150, so your spread is 100. Are you going to kind of put 80 grand in for 100K of value? And that's where it tends not to make sense.
Yeah, I agree. I think my exercise price was $250 for 250,000 shares or something. So it was a much easier decision than that, your latter example.
Yeah. But no, it's a fair comment that if the strike price is low enough and if fair market value is low enough, really, really early stage in the company, then yes, I think exercising, there's less risk. And like the leverage on your exercise when it costs $250 total just isn't that much. So the cost, the difference in leverage available to you just is, in terms of dollars, is not that great.
Right. Yeah.
So where were we? So with non-qualified stock options, very roughly, if it's a publicly traded company, because you owe the taxes when you exercise, and you probably want to sell the stock to cover those taxes, waiting until you're ready to sell all of the NSOs. Again, assuming there's not much leverage left, there's a big difference between your strike price and your sales price. That would probably be the next thing I think of when we're looking to sell out of the stock. So RSUs first, kind of then NSOs. The difference being, you know what? I think I want to probably back up now that I'm kind of thinking about this. The next thing I'd probably sell after RSUs are previously exercised ISO shares. I think that's why I was bringing up the comment about the NSOs. We tend to wait to exercise until we're ready to sell. With ISOs, if we're trying to get that long-term capital gains treatment, we have a exercise and hold strategy. So if we have successfully implemented that exercise and hold strategy in the past, and we now have qualified ISO shares that would be all long-term capital gains, that would probably be the next thing to sell. The kind of after the RSUs, which will be taxed at vest at already income, we have no control on that. I'd probably look to sell ISOs that have already received long-term capital gains treatment. But again, that means we've had to have done that in the past. If we haven't exercised any ISOs, and so I have both unexercised ISOs and unexercised NSOs, and I'm trying to sell some stock for either liquidity or diversification purposes, I would sell the NSOs. I wouldn't exercise and hold. I might use some of that liquidity to start the exercise and hold strategy for the ISOs, but it would be kind of RSUs, then shares that are qualified for long-term capital gains treatment. This could also be ESPP shares that I bought over a year ago. So kind of it's hard to identify the strategy like at any single point because so much of the decision depends on what we did in the past. But if we haven't done anything yet, we're 6 months past IPO, so there's no lockup concern, but we haven't done any of our exercises yet. We haven't satisfied the holding requirements for the ESPP. In that case, I would go RSUs first, then NSOs, where I'm actually selling options. If they were another 2 years down the road, maybe I have some ESPP shares and some exercise ISOs, then I have long-term capital gains treatment. So that's why I say it's not a perfect, like, this, then this, then this, then this. It's kind of, you need to understand the tax rules at least just a little bit so that you can kind of be ready to look for which ones to sell.
Right. So with the ISOs, what you're saying is just keep an eye out for, 2 years from the grant date and 1 year from the exercise date so that you can get that preferential treatment on long-term capital gains.
Correct. So if you have satisfied the long-term capital gains, then, because it also works kind of for the SVP. If you've held on to it for, pretty sure it's 2 years from participation and 1 year from purchase, that also could be long-term capital gains. So again, it's kind of, if you haven't done anything, then it would be probably the RSUs, then the NSOs. That's kind of allowing us, usually providing liquidity either for exercise or for taxes, that usually allows us to then implement the ISO exercise and hold strategy or not have to sell the ESPP. So that's kind of like if we haven't done anything, RSUs or NSOs could give us some liquidity to be able to cover, say, an AMT bill or raise our ordinary income where we can exercise more ISOs without going to AMT. We have a little bit more options there. But if we did exercise ISOs while the company is still private and now we're looking to sell, this might those long-term capital gain shares will probably be next. This could also be, I've seen, making sure we don't sell QSBS shares that haven't satisfied the 5-year holding. So we might be selling long-term capital gains, but not the long-term capital gains that are eligible for QSBS, and not the short-term capital gains. So we're actually selling like the middle lots that are long-term capital gains, not QSBS, not short-term. That sometimes happens as well. So I think RSUs, then probably qualified long-term capital gains shares, whether it's from ESPP or ISO, then probably the NSO options. Then this is kind of where even the NSO options or ESPP shares, does that make, like, those components make sense as I think about them?
It does. And, as we mentioned last week, you may want to time the NSO sales for the same year as the ISOs to increase the bridge for AMT concerns.
Yes. If we exercise and sell NSOs, we've increased our ordinary income, created more of a gap between the AMT calculation and the regular calculation, allowing us to exercise more ISOs without going into AMT. That's a good call. Thank you for that. But I think when comparing ESPP to the options, it's usually the leverage of the options versus the guarantees on the ESPP. So there's a decent amount of time where we're going to hold on to we're selling the RSUs, we're holding on to the options for the leverage, then we're selling ESPP shares. It's okay to give up the long-term capital gains qualification because we're paying ordinary income on a guaranteed rate of return, if that makes sense. We talked about an example where you're guaranteed at least that 17.6% rate of return. Most of the time, your return's even bigger because you have that look-back provision where if it's currently $10 and it was $20, you're buying at $10, so you got a discount. But if it was $10 and it's now $20, you're still buying at a 15% discount from that $10 share price. So you're already gaining $11.50. Now you have to pay ordinary income tax on that $11.50, but you're gaining $11.50 per share, and you have the options, especially with the leverage, and the leverage will help. If the stock goes up, the options will go up more. At this point, you're trying to actually balance in a strange way leverage of options versus the difference between long-term capital gains and ordinary income on the ESPP. The idea is like, okay, I need to sell some now because of, again, diversification, liquidity, whatever the reason is. I'm looking to sell some now, and I'm holding others. I'm ready to hold them for at least a year and taking on that risk. So here, again, the ISOs are the best thing to hold on to, or doing an exercise and hold strategy. The NSOs, if there's good leverage, we can hold on to that. If there's not good leverage, we could sell the NSOs. But if there is good leverage, then selling out of the ESPP, we've still gotten that really good guaranteed rate of return, but we don't have the leverage on the ESPP the way that we do with the options. So there could be scenarios where you're selling the RSUs right away, and then selling the ESPP as soon as you can is the next best strategy while you're holding on to the options. So that's why I say this is kind of the example if you don't have any shares that have already satisfied long-term capital gains. And so this is the one that can feel maybe counterintuitive, or I'm speaking on both sides of my mouth, where we said sell the qualified shares, which can come from ISOs or ESPP, so the long-term capital gains. But if we're selling sooner, let's sell the ESPP before the ISOs, where we're not giving the ESPP a chance to be qualified, mostly because we don't have any leverage once we purchase it, and so we're kind of taking on all the normal stock risk, where we could be getting that guaranteed rate of return. We could be diversifying with our money that was already won, if that makes sense.
Right. So you get some more flexibility there, essentially.
Correct. Well, kind of, if we know we need to sell these stock, whether again diversification, liquidity, or lifestyle, there will be scenarios where selling ESPP and holding on to the options makes more sense. There are other times where holding on to ESPP shares and selling NSOs with a high leverage so that we can exercise and hold ISOs, that can also make sense. So the unexercised ISOs is kind of consistently last, unless you're getting to the 10-year expiration date. But let's say we're still 5+ years away from that. Unexercised ISOs tend to be last. RSUs tend to be first. Then unexercised NSOs, long-term shares, and ESPP are in the middle. And which of those three you do first kind of depends on how much you're looking to sell and leverage of the options.
Mm-hmm.
Does that make sense?
It does, but just to be clear, so if you do have the unexercised ISOs and you still have many years left before your 10-year window ends, is there any real reason why you would want to exercise them until you get pretty close to that 10-year window?
If you're trying to spread out AMT over multiple years, like
There
try
we
to do
go.
a little
Right,
bit each year.
right. Good, yeah,
Um,
good deal. You don't want to take a lump sum all at once if you
yeah,
can amortize it.
exactly. So you get in the situation like, yes, we're doing this. So that's why realistically, it's never like a static moment in time kind of decision. It's usually okay, we'll do this now, see what the stock does, do this next time, see what the stock does, and kind of creating as much balance and flexibility between tax efficiency, liquidity, and reactions to ups or downs in the stock price. Because
Right.
kind of an example might be if we had the strategy and the stock price jumps by 100%. And it's like, okay, we weren't expecting the stock to go up that much. We can achieve all of our lifestyle goals by just selling now and paying ordinary income taxes. Like that, like we had the strategy of tax efficiency and the stock went up so much, we're just cashing out. We're cashing out now and paying us all the ordinary income taxes. That's okay. That's
Right.
a common example where we're reacting to what the stock does. We have a plan if the stock stays flat. We have a plan if the stock goes down. We have a plan if the stock goes up. But sometimes it's beyond anything we've planned. So yeah, I've done that a couple times where stock went up so much, like okay, we're selling more, even though that was not part of our tax efficiency exercise and sales strategy.
Right. Back to rule number one, no need to take on risk if you don't need to.
Kind of, yeah. So, whereas the stock goes down, it's like, oh, well, okay, we were planning on selling NSOs and ESPP, but the stock price going down actually increased the leverage on the NSOs. And so we were planning on exercising NSOs and holding ESPP. Stock price goes down. Okay, let's still take our guaranteed rate of return on the ESPP. We'll sell those shares, hold on to the options, which actually could even be underwater. Like that's a possibility depending on when the grant was and when how much the stock has gone down. So like
right.
that's an example. You're never going to exercise and sell underwater options. It just you're literally losing money. So holding on to those options, see, hey, let's see the stock comes up, and we have 10 years to wait. Or maybe we have another still 8 years left. We have a 10-year expiration period. We've got 8 years left. Let's see if the stock comes up. We still want to get some money out. So that's an example where we'd be selling RSUs and ESPP. We would not be selling any options. So that's kind of like a way that the plan can change as stock goes up or down.
It's certainly not linear to try to figure this out. It's like a web of things going around and like circling, and you got to try to, navigate yourself pretty precariously, it seems.
As long as you kind of have the conversations, come up with a strategy, we know why we're selling. That tends to be almost the harder part of the conversation is what is this money for? Because sometimes like I'm going to keep working and saving my 401k and I want to see if I can kind of make a lot more money than I could just by working and saving my 401k. And I don't want just like 1 year's worth of salary in stock. I want to see if I can get that life-changing wealth kind of thing. Then okay, we're going to do kind of a lot of exercise and hold strategies, but we're going to take our time and do it as efficiently as possible. Kind of spreading out the exercise over multiple years, but we may not be. That's kind of like the options might be cheaper than the ESPP. Well, no, the ESPP don't have a choice on the purchase. You participate, you purchase, you get whatever it is. So, yeah, there are ways to kind of spread that out. But if you need the money sooner rather than later, then okay, let's plan on, we want to take on less investment risk. Let's sell more. And that might be like, again, selling RSUs, ESPPs, maybe NSOs, just holding on the ISOs.
Right. So I guess that brings up an interesting point. Is there any reason why you would turn down an ESPP?
No. Everyone who has an ESPP available to you should participate.
Okay. So it's even better than that 401k match where, if you have the option, take it.
Correct. I guess if there's no discount. If there's no discount, then yes, company match would be better than the ESPP.
Right. Yeah. I'm assuming there's a discount. Yeah.
Sure. Even if there is a discount, as long as there's a look back provision, so if there's no discount, no look back, then yeah, you can get the exact same thing, just putting money in a brokerage account and buy your company's stock. Right. And it's like it's almost worse than your RSUs. Because you don't get any like delayed taxes. It's just coming out of your paycheck. You'd be better off just buying in a brokerage account. Right. But if there's a discount, and especially there's a look back period, because it pretty consistently, that look back period takes advantage of stock volatility in a way that nothing else does.
Right. I mean, so I guess obviously if there's no discount or ESPP, this isn't really some sort of, employee.
It's not really a benefit there.
Benefit, I guess. So maybe keep an eye out for that. And
yeah. It's like, why would the employer even take the time to set up the plan if no one's going to participate?
Well, I'm sure the benefit plan package is 1,000 pages long to explain.
Yeah. There's administration cost for the company. Like, this is a employee benefit that you actually want them to improve their lives.
Right.
So, any other questions on kind of if you have all four RSUs, ESPP, NSOs, and ISOs? Anything else you can think of in terms of those edge cases that might come up?
Well, I think we covered a lot, Aaron, and I certainly took a lot of notes. So thanks for the conversation. I think we did cover most of what I wanted to understand as well.
I love having these conversations. Again, the conversation with clients is always about what is the money for first. This is just like an optimization problem, which is kind of fun for me. So if we can get those hard questions first, then this is the fun part. But right. I love talking about it with clients. I love talking about it with you too. So thank you.
Great. Well, thanks everybody for listening. If you've ever come across a situation where you've had multiple competing employee benefit plans to think about, just let us know. And maybe what we've covered has covered it. And maybe there are edge cases that we want to think about. And, thanks everybody for listening.
Bye.
Bye.
We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.